Friends, in this video for ithought Advisor, I'm going to talk to you on the topic, the benchmark obsession. Today, every investor has only one aspiration. He wants to do better than everybody else. And he wants to know if he is doing better than what everybody else is doing. So he needs some kind of a benchmark. That benchmark is the Nifty, if you are in large caps, or if you just want to have one market-wide reference. But you have a variety of other benchmarks like sectoral indices, small cap, mid cap indices. You have multiple benchmarks. So if you really want to measure yourself against something closest to your style of investing, there are plenty of benchmarks. Most people stick to comparing only with the Nifty or the Sensex. This is because it is easy to follow. Everybody knows one moving number and you are able to compare what you have done vis-a-vis what the index has done. But throughout my experience as an investor, I've never really worried about benchmarks. There has never been a reason to worry about the benchmarks. The simple reason for that is that whenever the markets are down, I've always tried to invest more. And when the markets went up, the results were very, very rewarding. I also had the risk appetite, which was higher than the benchmark. Now, when I observe most investors who come to us, most investors don't have even the benchmark level risk appetite. The level of risk which they can afford to take is much lower than even the risk of investing in the Nifty, which means that you have to go for a dynamic asset allocation. You need to buy multiple assets and you need to keep their risks lower in order to earn decent returns. There are times when you err on the side of caution and take lower risk, and sometimes the results don't work out at all. For example, if I bought gold in the post-COVID era, hoping that gold will be a safety net for the investor, it turns out to be a problem point, a pain point for the investor. This could be temporary, but it does become a pain point. Similarly, if you try to buy defensive businesses like FMCG, either thematically or in a fund which has only such quality companies, that turns out to be a risk for the investor because the valuations are high. So, when you think you're taking lower risk, you end up doing something which comes out the other way. When investors have lower risk appetite than the benchmark, should an investor actually compare the benchmark to his portfolio? If you're owning 25% in liquid funds, 10% in gold, and the balance 65 in equity, how can you really compare with a benchmark like the Nifty? Now, this is a question which every investor should ask himself. If you are a conservative investor, does it mean that the Nifty suits your risk appetite? Probably not, because Nifty has all sorts of companies. It has expensive companies, it has high risk companies. The largest Indian groups are taking very, very high business risk to grow. So, Nifty essentially is not a safe benchmark. So, what should be a safe benchmark? I think investors should get accustomed to setting benchmarks in line with their risk appetite, set the expectation in line with inflation and interest rates, and say that these are the rates of inflation and interest rates, and I would be happy to earn so much more than that. It could be 2, 3, 4, 5, 6% more than rate of inflation and the rate of interest. That should align with your risk appetite. So, there is really no need for an investor to hug the benchmark like a Nifty and always think that he should beat it, because he could have a risk appetite way higher than the Nifty like I had all my investing years, or he could have a lower risk appetite like many of my friends who are extremely conservative and don't want to take too much risk. It's not wrong to have a low risk appetite, but it is not right to compare yourself with a benchmark which has a higher risk appetite. This is something which investors can learn, adapt and appreciate better. Thank you for watching this video.